Happy New Year and welcome to 2026. I'm Jonathan Zimpleman, Wealth Advisor with Axis Wealth Planning. If you're watching this, chances are you've heard a lot of noise about the markets over the past year. Some good, some confusing, and some honestly pretty stressful stuff. Well, today I want to take a step back and look at how the major stock and bond markets performed in 2025, why they moved the way they did, and most importantly, what lessons long-term investors can take away from the year. We'll keep this straightforward, skip the Wall Street jargon, and finish with a look at what I'm watching as we head into 2026. "2025 turned out to be a better year for investors than many expected, especially considering where we started, the fears of the impact of the newly announced tariffs that started earlier in the year. Inflation continued to cool, interest rates stopped rising, and corporate earnings held up better than feared. That combination helped both stocks and bonds, which isn't something investors could say for much of the previous few years. Well, let's start with U.S. stocks. The S&P 500, which tracks large U.S. companies, posted a strong double-digit gain in 2025. A big reason was continued strength in technology and communication companies, especially those tied to artificial intelligence, cloud computing, and productivity software. That said, the market story isn't just about a handful of big names. Mid-size and small companies also had positive years. They benefited from lower inflation and hopes that interest rates would eventually be coming down. While they didn't always keep pace with large companies, they did show signs of renewed life. My takeaway here, market leadership broadened in 2025, which is generally healthier than just relying on a handful of stocks. International markets had a mixed year, but it was an improved year. Developed markets like Europe and Japan delivered solid mid-single and low double-digit returns. Japan stood out as companies focused more on shareholder returns and corporate efficiency. Europe benefited from easing inflation even as economic growth remained relatively slow. Emerging markets, though, were much more uneven. Countries tied closely to global trade and commodities did pretty well, despite tariff fears. Others struggled with currency issues and political uncertainty. The big point? Diversification outside of the U.S. helped in 2025, but results varied widely depending on region. Now let's talk about bonds, an area that many investors have all but written off in the recent years. 2025 was a much better year for bonds than the previous few years. With interest rates stabilizing, bond prices stopped falling. It's important to understand the relationship between bond values versus interest rates. It works kind of like a seesaw. They work opposite of each other. So when interest rates go up, the value of bonds goes down. But when interest rates go down, the value of existing bonds goes up. That's what happened a lot of this past year. Many investors actually earned returns from interest payments again, something bonds are actually meant to do, but we haven't seen for a while. Different types of bonds did behave differently, though. High-quality government and corporate bonds delivered modest but steady returns. Lower quality bonds offered higher income but came with more volatility. For conservative investors, this was an important shift. Bonds once again provided stability and income, not just frustration. So why did 2025 turn out the way that it did? I think there was a few key reasons. A big one was that inflation cooled. Prices didn't fall dramatically, but they stopped rising as fast, and that really matters. Because of that, interest rates paused. Even without cuts up until the very end of the year, just knowing rates weren't climbing helped markets breathe easier. Also, corporate earnings held up. Companies adapted better than expected to higher costs, to higher borrowing rates, and frankly, the tariffs. And also, we had an investor expectations reset. Although we had a rough stretch in prior years, investors became more realistic and markets didn't need perfection to rise. There are a few important lessons worth highlighting. Markets often do better when fear is high, not when confidence is perfect. There's an old Wall Street saying that markets climb a wall of worry. Also, diversification mattered. U.S., international, stocks and bonds all played different roles. And staying invested proved more effective than trying to time headlines. Very important. As we look ahead to 2026, here are 4 key things that I'm going to be watching closely. Number 1, interest rate cuts. Markets are watching very closely to see if and when the Federal Reserve further cuts rates. Rate cuts could help both stocks and bonds, but only if inflation stays under control. Right now, expectations are for a few cuts throughout the year. Number 2, economic growth. Will the economy slow gently or reaccelerate? A soft landing remains the goal, but surprises, good and bad, can change market leadership really quickly. There have been many promises of new industrial investments by companies from around the world. Will they begin to come out of the ground and result in new U.S. jobs? I don't know. Number 3, corporate earnings. Earnings growth will matter more in 2026 than excitement or headlines. Companies that can grow profits in a slower economy are likely to stand out. Again, much has been said about the efficiency gained from artificial intelligence. We finally begin to see the impact on corporate bottom lines. Number 4, elections and geopolitics. Election years and global tensions can add volatility. History shows that markets don't love uncertainty, but they do adjust once clarity emerges. I will note, as I started putting this together, the U.S. military made a move on Venezuela and captured dictator Nicolas Maduro. This may have many unknown impacts in geopolitical relations this year. If 2025 reminded us of anything, it's that markets are forward-looking, unpredictable, and resilient. A thoughtful plan, proper diversification, and long-term discipline mattered more than reacting to every headline. And that's what's likely to remain true in 2026. Thanks for watching. If you have questions about how your investments fit into the bigger picture, feel free to reach out to us at Access Wealth Planning. We are always here to help, and I wish you a happy and prosperous 2026.